Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending April 8th. We're continuing a theme that we started last week, kind of shifting gears a little bit from when the podcast is released. So the podcast is going to continue to be released on Friday mornings. We're recording this Thursday afternoon. And so at the time of this recording, we're seeing some of the major domestic equity indices kind of pull back a little bit, continuing a little bit of the theme that we saw with movement there yesterday on Wednesday, but we'll get into more of that here in just a sec. My name is Ian Saunders, and joining us here as well is Will Gibson. And Will, it's great to be actually sitting across the table from each other instead of staring at each other in the cameras when we're recording these.
Yeah. I think this is probably the closest we've sat and done a podcast in the past couple of years.
2 years, hard to believe. We're getting people back into the office over the course of the past couple of weeks, and I mean, it's been crazy to see some of the changes that have occurred in some people, but other people remain certainly the same. And one thing that has certainly not remained the same is movement in the major indices over the course of the past couple of years, and specifically looking at the first quarter of 2022. We wrapped up the movement. Well, we wrapped up movement in the first quarter with movement last week, kind of heading into the second quarter of the year, and a lot of turbulence that we saw going on in the broader markets throughout the first quarter there, Will.
Yeah, a lot of movement. I mean, the big performance numbers can be deceiving. Like if you're looking at the S&P cap weighted down 4.5% or so, equal weighted down 2.5%, 3%. But like what we'll talk about under the hood, there was a lot of action that you saw. So it maybe kind of blanketed out with some of those big macro movements. The Q's down almost 9%. Which you say, okay, that's around correction territory. But again, there were some periods where it was much worse than that. It certainly felt a lot worse at times when we were looking at this and watching it daily.
Yeah, absolutely. And I mean, you look at some of that movement that you can see really in looking at the 25-point chart of the S&P 500 index, ticker SPX for those that are following along on the platform. I mean, you saw that top out at a chart level of 4,800 back in December of last year, and then began to move pretty sharply lower on that 25-point chart. Ultimately moving into a negative trend in February, bottoming out at 41.25 level, kind of toward the middle to late February there. And you begin to show a little bit of upside improvement as we headed into the beginning of March. And then ultimately kind of found a bottom at 41.75 in early March, and then skyrocketed higher back into column indexes, bringing us back up to a chart level at 46.25 by the end of the first quarter. Movement over the last few days, as we've headed down the first few days of April, have seen that 25-point chart pull back a little bit to a current chart position of 44.75. So while it's never a great sign to see 1% down days for the S&P, I mean, we saw a lot of upside over the last 3 weeks of March there, which undid some of the movement, some of that big negative movement that we saw for the broader indices in that first quarter. So, I mean, in looking at the average domestic equity move over the first quarter of 2022. I mean, looking at major ETF representatives from the S&P 500, the equal weight S&P, mid caps, small caps, and then Qs, the average movement was down almost 6%, down about 5.8%. Qs, as you mentioned, being down the worst, down 8.76% over the first 3 months of the year. And the equal weight S&P holding up the best, looking at that only down 2.7%.
Yeah, when you start looking down that kind of performance table, which we'll put on YouTube if you're watching this, that you can kind of work your way down and see international equities fared worse on average, down about 7% from developed and emerging markets, averaging those out. Fixed income was probably one of the biggest stories of the first quarter, and that trickled in to some of the equity markets. Probably that fixed income volatility was a big factor in that equity, specifically on some of the sectors. Commodities were definitely the shining star over the first quarter. Your average commodity fund up 20%, at least in this table, just looking at it from a broad paintbrush. And again, you saw a lot of those themes from commodities and fixed income on that equity sector front. So it's almost hard to talk about the equity market over the first quarter without bringing up some of the fixed income and commodity stuff as well.
Yeah, absolutely. I mean, it's very rare that you see U.S. equities down so sharply over the first 3 months, and fixed income down so sharply, right? I mean, we've seen some of that movement reflected in some of the different kind of cash rankings that we have. like looking at the asset class group scores, which we can dive into more in a little bit. But I mean, you saw that money market percentile rank, that cash rating kind of creep upwards. And that's not because a lot of domestic equity areas were moving beneath it, right? It's most of your fixed income groups and scoring in very low field position, and most of the international areas as well, scoring in very low field position. But some areas that are scoring higher, and that we saw pretty strong performance. And the first quarter was, I mean, by the commodities, no matter how you cut it, the commodities groups, I mean, they're still scoring strong, and they had some of the best returns over the first 3 months of the year.
Yeah. I mean, you look down the board at some of the ETF performance over that first quarter, and you're looking oil services, energy exploration, natural gas, equal weight energy, basic materials, even metals and mining. I mean, any way you want to spin it, the derivative of commodities themselves were the winners there. And we actually saw a lot of our models, our tactical sector rotation models, kind of pick up on this on the end of 2021, and they've rode that through the first quarter, which has been kind of a great alpha generator for some of those models. Because we've talked about this before, and like when momentum works really well is where you can overweight these sectors that are not big weights in your cap weighted benchmark, like the S&P, or even the equal weighted energy, basic materials, very small sectors by weight on in those. So we've seen some models latch onto that, and that definitely was to their benefit on the first quarter. And they're still in that position now as you start to work into the second quarter. And then on the worst side, so energy, commodities, and basic materials, really anything on that front was the winners. On the loser side, home construction was a major one. I think interest rates, again, kind of having to bring in some of the fixed income market moves has been a notable headwind there. The velocity of those rising rates has been a bit of a pain. And then technology, and you covered technology really across the board. You saw a lot of weakness there.
Yeah, I mean, certainly. I mean, you look across, I mean, any of the broad representatives showed pretty consistently negative returns. And we got some spikes. We got some names, especially towards the last 3 weeks when we got that kind of pickup in broader indices. Some of those growth oriented names, some of those kind of quicker moving names in the technology space, like some of your semiconductors and some of your software areas, saw some pretty solid spikes. We saw a lot of names moving back into positive trends, returning to buy signals, some giving consecutive buy signals. But that kind of near-term absolute movement hasn't really translated over to the relative strength side of the coin yet. I mean, you're looking at pretty negative returns there for like the dynamic semiconductors. The internet space especially is showing pretty sharply negative double-digit down returns of the first 3 months of the year. So, I mean, definitely want to keep in mind, even though we've seen some of these areas spike up a little bit over the last 3 weeks, we haven't seen that carry over to the relative strength side yet.
Yeah, I know early in the year, we were thinking semiconductors were in really washed out territory like other subsectors of tech. And we were looking for some type of mean reversion potential from there. We definitely saw some of that. But to your point, you really haven't seen the follow through. And a lot of our strategies and models right now are still underweight tech and have removed some of those positions at the expense of adding energy, basic materials, things of that sort. Even on the defensive front, we weren't planning to talk about this and not really shown on the tables, but like staples, utilities, some of the more traditionally defensive sectors held in there relatively well. Those are on the verge of getting added, and some of the models really haven't seen the full follow through yet.
Yeah,
but those are on there. Then if you look at like group scores, like you said, over the past quarter, our asset class group scores page, even Dolly a little bit, you're seeing staples, utilities held up pretty well.
Yeah. I mean, you're seeing since the end of February is when a lot of those groups started to show a lot of that kind of relative improvement in the rankings. I mean, we've seen that reflected in the utility space kind of picking up over 20 buy signals over the course of the past 6 weeks. Hasn't led to a lot of actual ranking improvement, at least on the side of utilities. They're still in the bottom half of the 6th position in the Dolly rankings through movement on Wednesday. But we have seen that carry over to the group scores. I mean, that group scores page, I mean, it tends to be a little bit quicker moving, a little bit more kind of in tune with your near term or more absolute movement. I mean, you look at the utilities group; it's one of the 3 broad sectors that's scoring north of that 4.0 score line, score posting of 4.37, and has the strongest score direction of any of the broad sectors, 1.97, almost a 2.0 kind of positive directional move for that utilities group. I mean, it is not something you typically think of when you think utilities. You don't think sharp rise in score direction. But I mean, we've certainly seen that carry over. And on the flip side, like you said, I mean, technology continues to rank down toward the bottom. Technology, consumer cyclicals, was previously for most of the past several years kind of the strongest areas from a relative perspective. I mean, they're down now down there towards the bottom. And we still see technology at 2.15 average score, sharply negative score direction. It's kind of looking like it's trying to bottom out from a scoring perspective. So, I mean, we haven't seen that translate over to broad score improvements, but that space has certainly looked pretty weak for the past couple of months.
Yeah. I think it's probably important too when you're reviewing a quarter like this, where you haven't really had a quarter like this in a while. 2021 was definitely messy, where it wasn't a clear, discernible period of leadership from any sector or for any size and style, but especially after 2020 and then 2021, markets as a whole were up just at different times throughout the year. So looking at this in perspective over a 2-3 year window, technology's had an incredible run. So some of that kind of perspective, I think, is going to be important here. Shifting gears a second, and I know we actually, we'll keep it with the sectors for now. We were going to talk about it later, but we'll talk about it now. Financials is one that we were talking about before. We might as well lump it in here. It wasn't in the best performing or worst performing. It started really strong on the year and was probably among the best performing for a while. And then we're talking about recently, that's another group that's dipped below, I'd say, some technically acceptable levels, or maybe just more loosely showing a bit of weakness and concern.
Yeah, absolutely. I mean, typically you wouldn't think of necessarily kind of higher rate movement as being a big kind of headwind for financials, but that's certainly carried over into that space from looking at some of that technical movement. I mean, the financial space still sits third in the dollar rankings. But again, that kind of quicker moving that group scores has shown a fair amount of deterioration. We saw the financials group with movement over the past couple of days actually cross down to a recent score posting of 2.95. Marking its first time beneath that 3.0 score threshold since November of 2020. So, I mean, it had risen significantly in strength. A lot of that big push for value at the end of 2020 saw financials rise pretty sharply. I mean, topping out score north of 4.5 and kind of hovered in 4.5 to above 3.5 for most of the next year to 18 months. And then movement over the past couple of weeks here has seen a pretty sharp decline from that financial space. Looking at it from that kind of absolute perspective. So again, haven't seen enough movement to change a lot of those relative strength charts, but that's definitely going to be a place to keep an eye out here for as we head down into the second quarter to see how that broader sector plays out. Yeah,
definitely. You would want some further follow through in one direction or the other. And even from like an individual or more specialized perspective, if you look at banks, I know on our call the other day, Joseph brought up JP Morgan, and I didn't know JP Morgan's a one attribute stock right now, which was a surprise to me, where I know this was a leader for a long time. Morgan Stanley's another one that's breaking down out of this big trading range. So it's a weird environment to see rates going up, banks, financials as a whole weakening. At the same time, you're seeing staples, utilities showing some decent improvement. And then you have commodities going gangbusters off the sidelines here. And then just to throw in another thing, the dollar is super strong. So it's just a very strange environment right now. A lot of moving pieces. It seems like there's still a lot of dust that's looking to be settled. It definitely was not settled over the first quarter, it seems. And it looks like the market's still trying to digest a fair amount of data right now.
Yeah, certainly. I mean, and then taking it back to like the broader index perspective. I mean, looking at like stuff like the S&P, like we're talking about, I mean, we've seen some negative movement over the past couple of days after a couple of weeks of very positive movement to end the first quarter. Kind of had a strong movement. Kind of, okay, we've been through the turbulence second quarter. I mean, let's see where this hits us. And then we get a couple consecutive big down days for the broader indices. But I mean, looking at that 25-point chart, it does not look that bad. I mean, you saw the chart again, as we talked about, top out in December, bottom out in the late February to March timeframe, and then move higher. And you would expect to pull back after being on such a significant stem like that. So, I mean, we saw a lot of names in some of these kind of more growth-oriented areas, some areas that you would typically kind of want to be looking toward in a stronger equity environment. They did move back to positive trends. We saw some of the indicators, positive trend indicators reversing back up into a column of X's, bullish percents, reversing back up, and now it pulled back a little bit. So, I mean, I think those trends, those longer term trend lines are definitely going to be a pretty important support level to keep an eye out there for in looking at movement throughout the next few months here.
Yeah, and the technical indicators, as you're getting at, are definitely in a better position now than they were definitely like midway through the first quarter of the year. So that is a positive. We're moving in the right direction, at least. Still just looking for that follow through, consistency, and where you need to be kind of concentrated. I think there's still plenty of opportunities, as we've mentioned. Some of those today that were the best performers last year are really still the case. Are still the case this year. And then something else, we wouldn't recommend trading on seasonality by itself, but recognizing that the month of April is historically the best month for stocks. And to put some numbers around that, I mean, since 2010, so over the past 11 years, we'll call it, April has been positive 92% of the time. And then if you go back since like 1973, that only drops to 71%, 72%. So April's a very strong month for stocks. I wouldn't discount that. Also, we're continuing to just see very bearish sentiment, whether you're looking like the AAII numbers or whatever you have, that it's there's a big wall of worry for markets and for stocks. They eat that up more often than not. It's a delicate environment for sure, but that's something to have in your back pocket when you're looking at your portfolios.
Yeah, absolutely. I mean, it's when everybody says to sell, it's typically the time that you want to be coming in and buying. And I mean, in looking at a lot of these stronger areas that we touched on, I mean, you're not seeing a lot of overbought stature from a lot of these. I mean, you saw a big pop up. But I mean, a lot of these energy, a lot of these base materials, some of those areas that have shown that consistent improvement. I mean, consistency is the key word there. I mean, you're not seeing, you certainly saw very overbought posture for energy at certain points in the first quarter. And that has normalized a little bit over the past few weeks and still is kind of a longer term positive. So definitely going to be some areas to keep an eye out there for.
Yeah, for sure. I mean, markets, we measure them in calendar years and quarters, but it's a continuous environment. There's nothing special per se about December 31st or March 31st, end of a quarter or year or quarter respectively, but just trying to gauge performance best we can in a finite way in a seemingly infinite environment is always a bit tricky.
Yeah, absolutely. And I mean, we continue to try to do that the best we can here, whether it's updates through this podcast. Luckily, we're able to be back in person and talk about it face to face, which usually makes for some more fruitful conversation. So, I mean, I think that probably wraps up most of what we're looking to cover this week. Will, it's great to be back in person with you.
Yeah, definitely. Thanks for doing it. If you're watching on YouTube, let us know if you like the new format where we've been changing a few things, and even on our weekly rundown calls, been changing those. So feedback is always appreciated there to help us be better. Help to you, help to others as well. So maybe we'll just go ahead and wrap up here. Thank you all for listening or watching, wherever it may be, and we'll look forward to speaking next week.